Tim, here's a look at the latest edition of Bloomberg Business Week. The cover story is also today's big take, and I hear it's written by one of Bloomberg's Quicktake's finest anchors.
Oh, you heard that?
I did hear that.
Who wrote it?
I actually wrote this
Oh,
story.
you did? Okay, congratulations.
Huge for me, first cover. I'm very proud of it.
In all seriousness, a huge congratulations to you because it is a very big deal to have the cover.
I really appreciate that. Thank you. And in this story, I go through the confusion on Wall Street right now over inflation. And for some, this moment is one of extreme career risk or a chance to be a hero to their bosses and their clients if they get it right. And Tim, this moment comes after mild inflation and low interest rates have helped to drive up stock and bond valuations. And now a daisy chain of supply chain bottlenecks has driven prices higher as companies fight to guard their profit and consumer demand remains high. Is it a post-pandemic blip that will resolve itself or a sign of more turbulence to come? It's a huge question.
It's a big question, and to help us answer it, we're going to have a discussion with Andrew Sheets, Chief Cross-Asset Strategist at Morgan Stanley. He made headlines over the weekend when he suggested that investors stay away from U.S. stocks and bonds next year and seek out better returns in Europe and Japan. We're also joined by Business Week finance editor Pat Regnier. Andrew, I want to start with you and specifically talk about what you wrote over the weekend. You wrote, quote, "We think that 2022 is really about mid to late cycle challenges, better growth squaring off against high valuations, tightening policy, rambunctious investor activity, and inflation being higher than most investors are used to." How are you seeing inflation in the context of the call that you're making to avoid U.S. stocks and bonds next year?
Yeah, thanks. It's really great to be here. So, look, I think you have a very interesting outlook next year where we think growth will be good and inflation will generally be coming down over the course of next year, but it will still be above average. And we still think that policy from central banks is going to become less helpful to markets. It's obviously been an extraordinary boost across both government policy and central bank policy into markets over the last 18 months. And so as this policy goes away, the usual pattern and kind of as the economy matures, as you get through the initial stage of that recovery is the valuations tend to come down, right? We saw that in, say, 2004, 2005 after the initial surge. So that's what we think happens this year. The inflation moderates a bit, but it stays above average. Valuations come down. And we think the U.S. is most at risk of those valuations coming down, which is why we're underweight the U.S. and think investors should replace that exposure with stocks in Europe and Japan.
And Pat, let's get into the psychology of this moment and what this means for people who manage money, because clearly Andrew is of the opinion that, inflation should moderate. But I mean, this feels like the question that you need to get right if you run money.
Yeah, I mean, I think if you're a professional investor, it's a big question. And inflation is baked into, all of the valuation models, the way that, investors think about, what is the appropriate PE multiple to pay for a stock, how they think about bonds. And one of the things that I think is really striking is that, you talk to people like this, there are a lot of people on Wall Street who've had fairly long careers who haven't really experienced a large inflationary event. So you have to kind of think about it in a new way. For a lot of folks, inflation is just something that you sort of put into your model and you plug in 2% or 3% and go from there. And now you actually have to have a call and a view of where it's going to go before you do anything else.
Andrew, this is a show for retail investors. It's for people who perhaps haven't lived through inflationary environments in the past. What would you tell them that they have to be on the lookout for when thinking about their own asset allocation?
Yeah, great. So look, I mean, I think, right, I'm sure some people listening into this and watching this have not experienced inflation before, and some of them maybe really have. So there's a lot of diversity of experience here. But I'd say a couple of things. I think first, big picture, I think stocks are going to be a better asset class in terms of protecting real return than bonds or cash or commodities like gold. I think that there's a lot of historical evidence that companies are generally able to grow their cash flow with the overall level of prices so that there is an advantage to stocks in a higher inflationary backdrop. Now, the other side of that, however, is that parts of the stock market have benefited enormously from a huge decline in the level of interest rates, especially the level of interest rates relative to inflation, what we call the real interest rate. And that has been a direct function of this big decline in inflation over the last 30 years. So if that big decline of inflation over the last 30 years or 40 years is over, then if that might mean this big decline in yields over the last 40 years is over, and it could put some downward pressure on valuations. And so if you're holding very, I think, high-priced stocks, the analysis that we run suggests that, generally speaking, the higher the PE of the stock, the more sensitive it is to changes in interest rates, and that presents some unique challenges.
And Pat, like Tim said, this is a show for retail traders, so we don't often talk about the bond market, but I feel like in this conversation about inflation, what could happen, we have to talk about bonds. And if you contrast what's happening in the bond market to the stock market, where, you know, it seems to be whistling past the graveyard a little bit, the S&P 500 of 25% this year. I mean, what are we learning from the bond market?
Well, I mean, as Andrew points out, I mean, yields are still very low. Which is another way of saying that the bond market is, you know, we're seeing high valuations on bonds. And what everyone is kind of waiting for is there a moment when people decide that they really are just going to start demanding higher yields to have a bond investment? And I think that's one of the things that people are kind of afraid of, is that kind of like change in market psychology, which we just haven't had yet.
Haven't had yet, TBD if it happens. But Andrew, I want to go to you for the last question, because if we look at your year-end target for the S&P 500, it sits at about 4,400. For some context, we're at 4,700 right now. What do you think is going to happen in the next 6 weeks to get us to that level?
Well, you know, so if we think about kind of getting to 4,400 by the end of next year, I think it's really all about the valuation. I want to kind of stress to those people watching, we're pretty optimistic about earnings. We have the S&P 500 making $245 at the index level for 2023. That's probably above the consensus. Where the entirety of our more cautious forecast comes from is thinking that the PE multiple on the market needs to come down. It needs to come down around to the 5-year average, which would still be above average. It would just be lower than today. And that's how you get to that lower price target. So the earnings will be better, the multiple will be lower. And we think that also means that there's a lot of single stock divergence within the overall market.
Morgan Stanley Chief Cross Asset Strategist Andrew Sheets and Business Week Finance Editor Pat Rainier. Thank you both so much. And don't miss this week's edition of Bloomberg Business Week, focusing on inflation. I'm in it. Vildana Heinrich is in it. Joe Weisenthal is in it. It's jam-packed.
Yeah, shout out about this cover. I talked to Joel Weber, editor of Bloomberg Business Week, earlier today about it. And it's sort of this nod to Ghostbusters and the idea of the ghost of inflation, because this is something that, you know, I think a lot of people who weren't paying attention in the 1970s or weren't around in the 1970s, it's not the type of environment they're familiar with. So this certainly harkens back to the history there.
I actually got SVU from this cover, which I also really love. Ghostbusters, too. In any case, strikes fear into my heart.
We'll be sure to pick it up. You can pick it up or check it out at bloomberg.com/businessweek.